Most property investors aim to build a multi-property portfolio instead of just sitting on one property. But without a proper loan structure strategy, you could end up sitting in a mess that can be very difficult to untangle. Welcome to the Finance Hub and Networks, your one-stop shop for all things home loans. Today, I want to talk about cross-securitization. Now, there are definitely a few positives to the strategy, but it can end up being one of those strategies that become difficult to untangle. We also want to be clear that the tax deduction benefits we cover in various examples throughout this video should not be considered financial advice. You must seek independent advice for your own personal circumstances. So cross-securitization is where the lender uses more than one property as security for a loan. Let's say you have a property that you currently live in worth $1 million, and your mortgage on that property is only $500,000. Then you decide to buy another property worth $500,000. Most of the time, mortgage brokers and lenders will tell you to use the equity in your first property to secure the loan for your second property. So the second property is secured by both the home and the new investment property. There is more than one property being used as security for a mortgage rather than a standard home loan, where you have one property securing one mortgage. Most lenders will allow you to access your equity once your loan to value ratio gets below 80%, and you can use around 30% of the property value as equity. If the second property in the previous example costs $450,000, then you could secure 100% of its value on your mortgage. Some investors continue with this strategy because it eliminates having multiple loans secured by multiple properties with potentially multiple lenders, and there's also some tax deduction benefits. But structuring your loan this way can be super risky because if you can't pay your home loan, the bank can decide which property to sell to settle the loan. This could potentially mean that they could force you to sell your own home rather than one of your investment properties. So it's worth considering structuring your loans in a way that reduces the risk. For example, instead of securing 100% of the new property's value on your mortgage, you can secure 80%. This way, you would not need to pay lender's mortgage insurance. Then you can borrow 20% with a different lender to pay for stamp duty. This way, you're splitting the risk and not putting all your eggs in one basket. But cross-securitization can get quite complex, so chat to a mortgage broker about your existing mortgages and your options. Make sure to like and subscribe to learn more about what's involved in your property purchasing journey.